Everybody tells you, just invest in the S&P 500 and forget about it. Your parents, finance influencers, and even Warren Buffett himself. But nobody explains what it is, how it works, or what the real trade-offs are. Most people own the S&P 500 for decades without ever really understanding what it is. So let's start at the beginning. In 1957, a financial data company called Standard & Poor's set out to answer a simple question. How is the American economy actually doing? Not one company, not one sector, but the whole thing. Their answer was to create a single index tracking 500 of the most significant publicly traded US companies. That index became the S&P 500, and today it's considered one of the most important benchmarks in global finance. But not every company in the index carries the same weight. The S&P 500 follows a free float methodology, which takes the market cap of each company divided by the overall market cap of all 500 companies. The market cap is calculated by taking the number of publicly traded shares and multiplying it by the share price. The free float method ignores shares issued to governments, employees, and private equity, which cannot be freely traded. Because these locked up shares do not represent real market activity, the free float method better represents what investors think the company is worth. A lot of people think that the S&P 500 simply tracks the 500 largest companies in the US, but that's not exactly the case. Getting into the S&P 500 is more like passing a rigorous application process, and even passing it does not guarantee that you get in. First, the basics. The company must be based in the US. It has to be listed for at least 12 months in an eligible exchange, such as the New York Stock Exchange or the Nasdaq. This ensures that the prices represent real trading history, not just IPO volatility. Second, market cap. The company must have at least $22.7 billion in total market cap, which automatically excludes over 90% of all listed companies. Additionally, at least 50% of the company's shares must be publicly traded. Third, financial health. The sum of 4 consecutive quarters of net income from continuing operations is positive, and the GAAP net income in the most recent fiscal quarter must also be positive. Note the keyword continuing operations in this definition. This excludes asset sales and one-time events which are not part of the company's long-term profitability strategy. Fourth, liquidity rules, which represent how much of the company is being bought and sold relative to the company's size. The ratio of trading volume to the stock's market cap must be at least 75%. For example, a company with market cap of $10 billion traded $5 billion of shares over the last year. This ratio would be 50%, and so the company would not pass this criteria. The stock must also have traded a minimum of 250,000 shares in each of the last 6 months leading up to the evaluation date. These liquidity rules exist for a reason. They ensure that large passive funds can buy the stock without distorting its price. Here's the part that most people don't realize. Even if a company passes all of these criteria, size, profitability, and liquidity, it doesn't mean that they'll automatically get added to the index. The final decision belongs to the S&P Dow Jones Indices Index Committee, a small group of analysts and economists who exercise real human discretion over which companies get in. They consider things like sector balancing, making sure that the index represents the whole economy and not just one specific industry, and the timing of when a company gets added to the index. The most famous recent example of this is Tesla. In September 2020, the committee surprised the investing world by not including Tesla in its rebalancing of the index, which caused shares to drop 16% in one day. The company had already been meeting the financial and market cap requirements for months, and was already one of the biggest companies in the world. Although the committee doesn't comment on the exact reasons for not adding Tesla at the time, investors speculated that Tesla's volatility and the quality of its earnings may have played a role. Selling regulatory credits to other automakers brought in $1 billion worth of revenue in the last 4 quarters leading up to September 2020, which was over double its profits from the same time period. This caused concerns about Tesla's ability to sustain its profitability in the long run. Tesla was eventually added to the index in December 2020, making it the largest company to ever be added to the S&P 500, with a market cap of $437 billion at the time. As seen in the Tesla example, this S&P 500 isn't static. Companies are being added and removed from the index as business conditions change. And interestingly, the bar for staying in the index is lower than the bar to get in. This ensures that companies aren't constantly cycling in and out of the index due to minor fluctuations. A recent example of this: in September 2025, Caesars Entertainment was removed after its market cap fell below the threshold, and it was replaced by Robinhood, whose explosive growth made it one of the most anticipated additions in years. So now you know who gets into the S&P 500 and how they're weighted. But what does the index actually look like in 2026? What sectors dominate? What companies carry the most weight? And what does that mean for your investment? The top 10 companies in the S&P 500 include the so-called Magnificent Seven, which is a group of tech companies that includes Nvidia, Apple, Microsoft, Amazon, Google, Tesla, and Meta. These companies alone represent roughly 35% of the index. If we look at the overall sector balancing, IT and communication represents 46% of the total index. And keep in mind that companies like Tesla and Amazon are classified under consumer discretionary. So even some companies that are considered tech companies are not included in this IT and communications category. Now you might look at this and notice that the S&P 500 is pretty concentrated around a handful of tech companies. That's a valid concern, and we will talk about this later. But first, let's look at why, despite everything, the S&P 500 is still the main investment in millions of portfolios. First, consistent returns over time. Since 1957, the S&P 500 averaged annual nominal returns of around 10%, or roughly 7% if we account for inflation. Second, lower fees than active funds. The average fee for actively managed funds is between 0.25 and 1%. In comparison, VOO, a passive ETF that tracks the S&P 500, has a 0.03% fee. To illustrate what this difference actually represents, let's look at an example. Let's say portfolio A starts off with $10,000. It averages returns of 10% and has 0.05% in fees. This is a classic example of a passive fund. That brings the real return to 9.95%. Portfolio B also starts with $10,000 and returns 10%, but it takes 1% in fees since it is an active fund. So this means that its real returns are 9%. This may seem like a small difference, but this effect really compounds over time. In 30 years, Portfolio A will be worth roughly $173,000, while Portfolio B will be worth around $133,000. That's a difference of $40,000, or 23% of the total returns. This brings us to our third point. It's really hard to beat the market, and even professional investors struggle to do so. In 2025, 79% of actively managed large cap funds underperformed the S&P 500, according to the SPIVA report. When comparing the long-term performance of active funds versus passive ones, only 21% of active funds managed to beat their passive counterparts over the last 10 years. In summary, by investing in the S&P 500 today, you're making a bet on the continued dominance of American large cap companies, especially the ones related to AI and technology. You also buy into the idea of market rationality and its ability to continuously outperform active investors. So the S&P 500 has a compelling case behind it: strong historical returns, low fees, and a track record that most professional investors simply can't beat. But no investment is perfect, and if you're going to invest in something, you should understand its weaknesses as well as its strengths. So here are 3 of the main concerns worth keeping in mind. The first is concentration. 40% of the index is concentrated in the top 10 companies, most of which are AI and tech related. This is no accident, since these tech companies have accounted for most of the S&P returns in recent years. For example, in 2023, the Mag 7 delivered 101% returns versus the equal weighted counterpart delivering only 2.5%. However, it's worth noting that although concentration has been increasing in recent years, it's not a complete historical outlier. In the 1950s and 60s, the index was also highly concentrated, and that did not affect its long-term performance. And unlike previous moments of high concentration, such as the early 2000s dot-com bubble, the top 10 companies today have strong balance sheets, with their collective earnings accounting for 30% of the index total. The second concern is trade-offs. Now you know what's in the S&P 500, but it's just as important to know what's not in the index. Knowing this will allow you to determine if investing only in the S&P 500 is enough for your portfolio. There are thousands of smaller companies, tracked by indices such as the S&P 600, that are not big enough to qualify for the S&P 500. Historically, smaller companies have commanded what economists call a size premium, the idea that smaller companies have more room to grow, and investors demand higher returns to compensate for the higher risk. This effect is seen when comparing the returns of the S&P 500 versus the S&P 600 over the long run. However, it's important to note that returns over the last decade have largely favored large caps over small caps. And the same logic applies globally. The S&P 500 only covers US companies, but stock markets across the world offer exposure to entirely different economies and sectors. And right now, most of them trade at a significantly lower valuation than US stocks. A lower price to earnings ratio means that you're paying less for every dollar of earnings, which in theory means more room for price appreciation. However, the S&P 500 has traded at a premium to international markets for decades and has still outperformed them over most long-term periods. It's also worth noting that many S&P 500 companies already generate considerable amounts of their revenue overseas. Companies like Google, Amazon, and Apple already have huge amounts of sales abroad. So even a pure S&P 500 portfolio already has indirect international exposure baked in. The third concern is the idea of passive crowding and market distortion. And this concern is slightly different from the previous two. It's not about what the index includes or excludes, but rather what happens when too many people invest in it at the same time. For the first time in history, more money is now invested passively than actively. Over $19 trillion currently sit in passive index funds. That's a huge number, and some economists and investors argue whether it's starting to distort how the markets function. Here's the mechanism. Large companies are represented in ETFs such as VOO proportionally to their market cap. Every time passive money flows into the index through 401ks, Roth IRAs, or automatic contribution, it buys those large cap stocks regardless of their valuation. That buying pressure pushes prices up. Higher prices increases those companies' weights in the index, which means that the next wave of passive money buys even more of them. This creates a self-reinforcing cycle where large cap companies increase their valuation, not because of business fundamentals, but because of mechanical buying. There's a related concern around diversification. As passive investing grows, individual stocks within the S&P 500 may start moving more in sync with each other, not because their businesses are similar, but because they're all being bought and sold together as part of the same index. If that's true, it reduces the diversification benefit that you thought you were getting. However, real data from the S&P Dow Jones so far does not clearly support this correlation concern. Stock correlations within the index have not dramatically increased despite the rise of passive investing. So far, the evidence for passive crowding is mixed. Some argue that there are still enough active investors to make up for any asymmetries created by passive funds, while others argue that markets may be more sensitive to passive flows than previously thought. However, this mechanism is still worth understanding, because if passive investment continues to grow, it could become more relevant over time. Keep in mind that none of these concerns mean that the S&P 500 suddenly became a bad investment. It just means that there are certain trade-offs that you have, as with any other investment, and any smart investor knows all of these trade-offs before putting their money in. So to wrap up this video, the S&P 500 was not created by chance. It was a set of deliberate choices about what companies matter, how much their weight should be, and what the American economy looks like at any given moment. But knowing what the S&P 500 is only the starting point, because knowing what it is does not tell you how to allocate your portfolio towards it, or whether you need exposure to small caps or international companies, Or how much should your allocation change as your life circumstances change? And these decisions are what determine your investment strategy, and that's what this channel is built around. Finally, none of this is financial advice. This is all for educational purposes. If you have any questions, drop them down in the comments. I read all of them. Thank you.